Hi everyone, and welcome back to the channel. Today we're going to be taking a look at the largest holding inside of my portfolio, VFV, or the S&P 500 Index ETF, and doing a deep dive of it as part of a new series that I'm doing where I'm just going to be going through each of my ETFs one by one and doing a deep dive so you can really understand why I hold each and every one of them. And this video is going to be geared more so towards beginner investors, or if you just need a quick refresher, I encourage you to continue watching. So the S&P 500, or as it stands for, the Standard & Poor's 500, is just an index of the top 500 stocks in the United States weighted by market capitalization. And in case you don't know what an index is, it's just a set of securities, in this case stocks. So when we say securities, it could be other ETFs or other closed-end funds, things of that nature. So in this case, it's just 500 stocks. And market capitalization, so it's weighted by market capitalization. It's just the total market value of all the company's outstanding shares. So you just take all the shares that everyone owns and you multiply it by the market price to get the market cap of that particular company. So inherently, because it's the top 500, it's going to be mostly made up of large capitalization stocks, or as it's commonly referred to, large cap stocks. So inside of the index, if a company's market cap increases relative to the other companies within the index, it will make up more of the index in that case. And vice versa. If a company's market cap decreases, it will make up less of the index and can potentially be removed from the index if it is no longer in the top 500 companies. So as an example, you have Microsoft that makes up 7.3% of the index, and then you have a much smaller company in Walmart that only makes up 0.57% of the index. If Microsoft's market cap increases relative to everyone else, it's going to be, potentially 8, 9%. So by doing this, you actually have a bit of a self-cleaning mechanism. You never have to worry about, oh, how's this company performing? No, it takes care of that for you. It just literally makes sure that weight is always based on how well the company is doing, essentially, because the investors of those companies are going to determine a fair value for them. So the most popular index that is used to track the performance of the companies in the United States. So the S&P 500 is always that golden index that's used to track it. There's other indices, however, like the NASDAQ 100 and the Dow Jones Industrial Average, or the Dow 30, because there's only 30 companies, believe it or not, inside of the Dow Jones Industrial Average. I don't know why, like when I thought of that index name before, I thought, oh, that must be a lot of companies. Well, no, it's actually only 30, which is kind of funny. Then you also have the Russell 2000. So, but out of all of these, the S&P 500 is that go-to that is usually used in the news to report on the performance of the United States. So I just want to show you this visual that's really gives a clear image of what you're buying when you're buying the entire S&P 500. So you have in this image here, the 11 sectors of the economy. The first one being information technology, where you have Apple and Microsoft, NVIDIA, IBM, Salesforce, Cisco, Intel, all companies I'm sure you're familiar with that make up a large portion of the index. So Apple being the largest right now at 7.5%, or at least in this image, I think Microsoft might have overtaken it. And then you've got your healthcare companies, which is the next biggest sector inside of it. You've got Eli Lilly, Johnson Johnson, Pfizer, all these massive healthcare companies inside of the healthcare component. And you got your financials, which I'm sure you're all aware of, Berkshire Hathaway, which is Warren Buffett's company, JP Morgan and Chase, Visa, MasterCard, Goldman Sachs, Bank of America, BlackRock, massive, massive companies inside of the financials. You have consumer discretionary, industrials, communication services, and then you have your consumer staples, where you have companies that were here. It says here over the last 20 years, the consumer staples have seen some of the lowest volatility compared to other sectors. Well, this is because like during, and inherently in the name consumer staples, during times like economic strife where people are low on money, they're not going out and buying, McDonald's and, Nike shoes and things like that. They're buying like the things that they need from the grocery store, things that you're going to need no matter what. So these are companies like Procter and Gamble, PepsiCo, Coca-Cola, Costco Wholesale, Walmart. Then you have energy, ExxonMobil, Chevron, utilities, materials, and real estate. So you have the 11 sectors of the economy, all comprised within the index itself, which with the highest amount being in information technology. But these are massive, powerful companies that have global reach. So it's not like any of these companies are just like, oh, we operate in the United States and call it a day. No, these companies operate across the globe and are massively influential on our everyday lives. So just think of that whenever you're buying VFE or any S&P 500 index ETF, this is what you're buying when you buy it. So amazing stuff there. I'm just gonna go back to the slideshow. Okay, so that's great, but how would I buy the S&P 500? Well, this is where VFE comes into hand. So it's a ETF by Vanguard created to track the S&P 500 index. It's traded on the Toronto Stock Exchange. Very important that you make sure you're looking for VFE.to. The inception date is 2012, November 2nd, 2012. So it's been around for over 10 years now. So we have a decent amount of history to see its performance. It gives out quarterly distributions. Now, there is a 15% withholding tax that you can't really avoid by buying VFV, but you can avoid by buying the fund inside VFV, which is just VOO, on the New York Stock Exchange. So, I mean, this 15% withholding tax, I mean, it can be avoided in the RSP, but in most cases, I would just recommend you buy VFE, unless you have like a really long time horizon, like I'm talking like 30 years, and you're willing to buy, switch your Canadian dollars to US dollars in a cost-efficient manner to try and buy the US dollar equivalent and avoid that 15% inside of your RSP. I would just say other cases, just buy VFE. So yeah, so like that's the only like little bit on the distribution. This has sparked so many conversations on platforms like Blossom. A lot of people asking about this, but just so you know, this is basically negligible on a fund that's not geared towards dividend yield. It is more geared towards maximum growth. So with that, you also have the performance of the US dollar relative to the Canadian dollar included in the performance of VFE since it is unhedged. So there is a hedged equivalent product called VSP, which basically takes that US dollar relative to the Canadian dollar and takes out all of that volatility. There's none at all. It's just hedged to Canadian dollars. But in the next slide, we're going to see, or in the next couple of slides, we're going to see why that might not be the best idea based on past performance. So the MER or management expense ratio is 0.09%, which is extremely low, and we'll get into that later. And you have assets under management of almost $10 billion now. And since inception, that November of 2012, you've got a 456% return, which is very nice. But then you compare it to the hedged version, which takes out all of the US dollar to Canadian dollar price fluctuations, and that performance is actually drastically lagging VFE. So this is why past performance isn't an indicator of future performance, of course, but when you take a look at the two equivalent products and put them side by side here, and you see a massive it massively favors the person who bought the unhedged product. I kind of recommend the unhedged product in most cases for most people, unless you don't have a lot of faith in the US dollar. That can be debated, but VFE has drastically outperformed VSP in the last over a decade now, based on including that unhedged position in the US dollar. So I wouldn't worry about that. I would always recommend just buying the unhedged version in VFE. So if we take a look at the competition, so Vanguard is the only fund manager in Canada offering S&P 500 index ETFs. You also have BMO or Bank of Montreal, BlackRock and Horizons offering their own products in ZSP, XUS, and HXS. All of them have the exact same management expense ratio except for HXS, which has a MER currently of 0.11, which is just a little bit higher, but it's basically negligible. And they all have very high assets under management in the billions. So very highly liquid ETFs that you can buy on the TSX. Now we'll get into why I'm buying VFE. The next slide, with an MER of 0.09%, you'll pay just $9 annually on a $10,000 investment. It comes out of the fund automatically for you. It's not like you have to mail a check to Vanguard. Here's your $9 if I invest 10,000. No, it just comes off. It just decreases the performance of the fund just that little bit, which is a very fair trade in my opinion. Because if you think about it, just a few years ago, before you had commission-free brokerages like Wealthsimple, um, and let's say it was like $9 a trade. If you can imagine paying $9 every time you bought a company inside the S&P 500, so that 500. If you had to go out on your own and buy those 500 companies, or even a subset of them, the commission fees would be insane. So if you think about it like that, all of that, you're giving Vanguard, some money. They go and buy those 500 companies on your behalf, and you only have to pay $9 on a $10,000 investment annually. Sounds like a fair trade to me. So in my case, I own close to $50,000 at VFE, and I pay just $44 annually to Vanguard as of now. Obviously, it's going to go up as I acquire more VFE, but that just to put things into perspective. Now we can see charted side by side those four funds. You can see that VFV Vanguard as the fund manager is just slightly better than all of the others. So at 275%. HXS, obviously, with that MER of 0.11, it makes sense that that little bit of extra expense ratio is going to mean that it's going to be trailing the pack. And then these ones are going to be just very close. So yeah, it's just slightly outperforming. So, I mean, honestly, it's honestly negligible. If you own JSP or XUS, they're great products to HXS too. Like, it's just for me, VFV is the preference as Vanguard is a excellent fund manager. So why invest in VFV? So to me, it's a great method to add US equity exposure to your portfolio. You get instant access to some of the most powerful companies on the planet that operate their businesses internationally, like I said before. And just in my own portfolio, the performance relative to the rest of the world is just no comparison. So I'm just going to show you the next slide here. We're going to look at the 10-year performance versus the S&P TSX 60, which is basically the S&P 500 of Canada. Think of it that way. It's like Canada's performance. Developed countries except North America and emerging markets. So just take a look at that real quick. So look at that performance gap. So you have here, this is Canada XIU, the very popular way of the S&P TSX 60 ETF. Then you have your developed X North America and your emerging markets over the last 10 years. And you compare that to VFE and the S&P 500, and there is just literally no comparison. It is completely destroying all of the other ones. So people might say, "Oh, why is your portfolio like almost like over 40% in VFE?" Well, this is why. I'm trying to get my maximum growth out of VFE. These other companies or these other indexes are great for added diversification, but at the end of the day, the one that's driving the key growth inside of my portfolio is VFE, and it's always a good buy to buy just dollar cost average whenever I have money. So. As far as risk tolerance, if you need to be able to stomach some volatility in favor of potentially higher returns over the long run. And we can see that in the graph here. We have the COVID crash. We've got the crash that happened in 2022. You have to be able to stomach this. I'm not going to say that that's easy. Seeing that in your portfolio, like going down that much. But you have to have faith, and this is why I showed you that visual of all the companies inside the S&P 500 ETF. If you have faith in all of those companies, and you know that it's a self-cleaning machine, those companies, like if they are not eligible to be in the S&P 500, they're going to get booted out. You have to have that confidence that you're investing in amazing companies that operate globally and have massive influence in the world, and know that those companies are going to be what is going to change the world long term. Something like this shouldn't bother you at all. You should see it instead as a buying opportunity. You should see these little dips as huge buying opportunities. Just, hey, look, I get to pick up more shares for the same price. So, and in the long term, it's just going to it's going to completely favor you if you pick up more shares, even when the market goes down. So, little things like that are going to really contribute to that maximum growth over the long term. So, with that, thank you for watching, and stay tuned for more of these videos. Thank you.